If you've been investing in the S&P 500 or maybe a Canadian index ETF, first of all, great. You're ahead of most people. But there's a question more and more investors are starting to ask right now. What if the next decade doesn't look like the last one? What if putting almost everything into North America turns out to be more concentrated than you realized? A lot of it comes down to geopolitical uncertainty, things we cannot control. And that's the whole point of diversification, guys. Manage your risk by not putting all your eggs in one basket. Luckily, we've got option, guys. International ETFs that invest outside of North America that can be a valuable part in your portfolio. So today I'm going to walk you through some international ETFs that are actually available to buy in Canada, what they cover and how they might fit alongside what you already hold. I've lined up 6 ETFs that I personally like. I am not sponsored or compensated in any way by any of these ETF issuers I mentioned in this video. Everything here is my personal opinion only, and I choose these ETFs based on my own criteria and my personal financial goals. Note that I am someone with a high risk tolerance, and I am prepared to see my portfolio dropping 30%, even 50%. Now, this may not be the case for everyone. I'm not an expert, guys, just a regular investor sharing what I've learned and what works for me. If you're someone who wants zero or very low risk, then this video is not for you. The purpose of this video is not to tell you what to buy, but to walk you through my personal thought process. Before you make any financial decisions, please carefully consider your own goals, financial situation, and risk tolerance, and consult a financial advisor for more guidance. Quick mention before we start, if you're just starting to invest, to actually buy any of these ETFs, you'll need an investment platform, ideally one with no trading fees. And there are a ton of investment platforms in Canada that are great, but the one I love and have been using for over 5 years is Wealthsimple. You can even get a $25 bonus if you sign up and fund your account using my link down below. Note, this is an affiliate link, which means that I may earn a small commission if you sign up. First, let me share with you the criteria I use to put this international ETF list together. First, I don't include ETFs that have big chunks of Canada or the US in them. That way, if you already have US and Canadian ETFs, you can avoid duplication. So these ETFs give you exposure to other countries. Also, I'm only covering equity ETFs, so stocks, no bonds are covered here. Second, I'm only including ETFs listed in Canadian dollars on the Toronto Stock Exchange. It means you do not need to convert your Canadian dollars into US or foreign currency. Also, I'm only including unhedged ETFs here. Third, broad international diversification, to get exposure to different markets and not to put all your eggs into one basket. Fourth, for the fund structure, I prefer ETFs that directly hold the underlying stocks instead of just being a wrapper around a US listed ETF. Fifth, I also want a low MER or management expense ratio, far below 0.5%. This is the annual fee of the fund that quietly reduces your returns, so you want this to be as low as possible. Sixth, the historical performance, not as a prediction because we can't predict the future based on the past, but just as useful context for how the fund has actually behaved in the past. And yield. As these are not dividend funds, the yield is just a nice extra to have in my opinion. Now with that said, let's dive into the ETF list. These ETFs are not strictly ranked, but I did group them into developed and emerging markets. Let's start with the developed markets options first. First up is the VIU from Vanguard. It tracks the FTSE Developed All Cap X North America Index, which basically means developed market stocks worldwide, excluding Canada and the US. You're getting exposure to Japan, the UK, South Korea, Switzerland, France, Germany, Australia, and even more. Over 3,600 companies across large and mid cap. A few names from the top holdings include Samsung, ASML, Roche, Nestle, and Siemens. The VIU uses direct replication, which means it buys the underlying stocks directly without routing through US listed ETFs. That means in a TFSA, your dividend income is not hit by an extra withholding tax, as would be the case if you'd bought an ETF that holds a US listed ETF. The MER or management expense ratio is quite low at 0.23%. Check for that. Now looking at the performance, the annualized return since inception was 8.75%. Trailing yield, so the yield looking backwards, was around 2.3%. All numbers as per making of this video. Personally, I think the VIU is a great ETF to start building an international sleeve. But let's move on to our other options. Next is XEF from iShares, BlackRock's ETF brand. The XEF tracks the MSCI EAFE Investable Market Index. MSCI is basically Morgan Stanley Capital International, and EAFE stands for Europe, Australasia, and Far East. It's a developed markets ETF and has around 1,500 stocks in it. There are a lot of similarities with the VIU I mentioned earlier, although it is just slightly more heavily invested in the top 10 countries: Japan, UK, France, Switzerland, Germany, Australia. But one important difference here is that the XEF excludes South Korea. The MSCI's index classifies South Korea as emerging markets, and I know it's a bit awkward since South Korea is definitely a highly developed economy, but it seems the reason it's categorized this way is because of South Korea's currency trading limitations and regulatory barriers. Now, the structural point. The XEF is primarily a direct replication fund, meaning it mostly buys the underlying stocks directly, except that its very first holding is actually a US-listed ETF, the iShares Core MSCI EAFE ETF, at about 3% of the portfolio. It's not a big component, but just something to be aware of. Continuing with its MER, it's 0.23%, very identical to the VIU. The performance since inception in April 2013 was 9.72%, and the 5-year average annual return of 10.55% as per making of this video in early June. The trailing yield was 2.22%, not too bad. Now, my take is that the XEF and VIU are pretty close. The main reason I would choose XEF over VIU is if I had a specific reason to exclude South Korea. For example, if I already had an emerging market ETF or plan to invest in one without South Korea already covered by it. Otherwise, the VIU has a slight structural edge for me personally because it does not wrap any US ETFs. Moving on to the next developed market ETF, the TPE from TD Asset Management, and it has one standout feature. The lowest MER on this list at just 0.19%. In general, all ETFs I mentioned on this list all have very low MERs already. Compare that with MERs of some Canadian mutual funds that are way above 1% to 2%. If MER matters to you, then 0.9% is a great deal. The TPE is all equity, although strictly speaking, it's 98.6% international equity with a tiny bit of cash, but it's practically all equity. The TPE tracks the Solactive GBS Developed Markets X North America Large and Mid Cap Index. It has similar coverage to VIU and XEF, covering developed markets while excluding the US and Canada, with a few differences. Some of the top holdings include ASML, HSBC, Roche, AstraZeneca, Novartis, Nestle, and Royal Dutch Shell. Like the XEF, TPE excludes South Korea, and unlike VIU, it's mid and large cap only, so slightly less breadth than VIU in terms of company size. In terms of structure, this fund does direct replication, so not wrapping any US ETF. Performance: since inception in March 2016, its annualized return was 9.41%, and over the last 5 years, 10.83%. Remember guys, these are all numbers as per making of this video, so they will change from time to time, so make sure you check if you make a purchase. Now, it was really difficult to find the trailing yield. I found the distribution yield, which was 2.69% here, but the distribution yield is forward-looking, while the trailing yield is what was actually paid out. So this number is not directly comparable. Just keep this in mind, and don't assume that the yield here is necessarily higher than any of the other ETFs we talked about. Personally, if I'm being really fee conscious and I don't have a strong view on small caps, TPE is very attractive. But if I wanted to have exposure to South Korea, I'd need to make sure I'd invest in another ETF. Emerging market ETF, for example, that has South Korea in it. We'll get into emerging markets now, but quick question before that. Are you currently invested only in the US and Canada, or have you already started adding some international exposure? Drop your answer in the comments down below. I'd love to hear from you. Speaking of all these countries inside these ETFs, made me realize how overdue I am for travel. I might just go to South Korea this year. One thing that used to stress me out on past trips was not having a reliable internet connection, and I used to connect to public Wi-Fi. But on my last few trips, I've been using Maya Mobile, which has changed a lot. I can stay connected and have a smooth internet connection just like here at home without coming home to a massive roaming bill. No physical card, just an eSIM from Maya Mobile you can set up completely online. And if you care about a 5% discount, check out my link below. It's also an affiliate link, so I may earn a small commission if you sign up. Now let's talk about emerging markets. This is where things get a bit more volatile, but also potentially more interesting for long-term growth. Emerging markets include countries like China, Taiwan, India, Brazil, South Africa, and Saudi Arabia, economies that are growing faster on average than developed markets, but with more political risk, currency risk, and price swings. That's the trade-off you're accepting when you invest here. The next ETF, an emerging market ETF, is the VEE. The VEE is Vanguard's emerging markets offering. It tracks the FTSE Emerging Markets All-Cap China A Inclusion Index. It has broad coverage, all cap, including small companies. Top country exposures are Taiwan and China at almost 30% each. A bit heavy concentrated in my opinion, so it really depends on what geographical exposure you're looking for. India at over 16%, then Brazil, South Africa, Saudi Arabia, Mexico, Malaysia, other Southeast Asian countries, but also Turkey and Greece. It does not include South Korea, which for me is more intuitive for an emerging markets ETF. A very interesting mix. The VEE invests in over 6,000 stocks. Now, the structural note, and this is very important, instead of buying these thousands of funds directly, the VEE invests primarily through underlying Vanguard funds, making it a fund of funds. As it says here, it invests primarily in the US domiciled Vanguard FTSE Emerging Markets ETF. That wrapper structure means the withholding tax issue applies more directly here. For Canadian investors, the VEE's fund of funds structure can create extra foreign withholding tax drag because dividends pass from emerging markets companies to a US listed ETF, then from the US listed ETF to the Canadian listed VEE. The first layer is withholding tax charged by the source countries where the companies are based. The second layer is generally a 15% US withholding tax on dividends paid from US listed ETFs to Canadian ETFs. So all in all, this wrapper structure can cause you to lose more of your dividend income. So personally, the VEE would not be my favorite emerging market ETF unless my plan were to combine it with another Vanguard ETF, which is the VIU. Remember, the VIU invests around 9% in South Korea, while the VEE does not have South Korea, so they can complement one another in this way. Just something to think about. VEE's MER is 0.26%, pretty standard. Since inception in November 2011, its annualized return was 7.12%, while its 5-year performance was almost 7%. Trailing yield was around 2%. Interestingly, the distribution yield here is 5.8%. Remember, the distribution yield is what the yield would be if the recent distributions were continued into the future. So this is an outlook rather than actual past payouts. Something to consider as well. Next up is ZEM from BMO, which tracks the MSCI Emerging Markets Index. Large and mid-cap companies across emerging markets, 99.93% in equity. Now compared to the VEE, the geographic mix is noticeably different. South Korea is much higher weighted at almost 24%, behind Taiwan at almost 26%, and slightly ahead of China at about 20%, with India at 11%. Note these numbers are all as per recording of this video in June. Then there's Brazil, South Africa, Saudi Arabia, Mexico, and so on. This is, in my opinion, a more balanced spread than VEE's heavier China tilt. Now looking at the structure, ZM uses a mix of direct holdings and a US ETF wrapper component, specifically the iShares MSCI Emerging Market ETF, which is a US domiciled ETF, which shows up at about 6.76% of holdings. So similar tax implications as we've covered before with the VE. And guys, note I am no tax accountant or specialist by any means, so always consult a financial advisor and or a tax accountant for more details. The MER is 0.27%, similar to the VEE. Now performance-wise, since inception in October 2009, the annualized return was 6.66% and the 5-year average annual return was 7.84%. And guys, just a reminder that past performance does not show future performance. The annualized distribution yield was 1.95%. I had a difficult time again finding the trailing yield, so note this is not directly comparable with the trailing yields I mentioned for some other ETFs earlier. Personally, the thing that makes ZEM interesting to me compared to VEE is the high South Korea weighting and the relatively lower China concentration. That said, it's large and mid-cap only, no small caps. But which one you think is better and more suitable for you will ultimately depend on your preference for geographical distribution. Now the next one is an ETF I find most compelling in the emerging markets category. XEC from iShares, which tracks the MSCI Emerging Market Investable Market Index. The IMI is the key part. It means Investable Market Index, which includes large, mid, and small cap companies. That's broader than ZEM, which stops at mid cap. The XEC also has almost 3,000 holdings versus ZEM's 921, so you're capturing more diversity within emerging markets. Country exposure is similar in shape to ZEM, Taiwan at the top, then South Korea, China, India. But the small cap inclusion shifts the weight slightly and adds depth. About the structure, XEC primarily uses direct replication, but like ZEM and XEF, it does hold some exposure through underlying ETFs in practice. Same withholding tax considerations apply here. The MER is 0.28%, which is pretty similar to the others. Performance since inception in April 2013, the XEC has delivered an average annual performance of 7.85%, and similar, almost 8% in the last 5 years. The trailing yield was 1.7%. Now, my personal take for emerging markets, if I had to pick one, it would be the XEC. Ideally, if I didn't have another ETF that already had South Korea in it to avoid the overlap. Unless, of course, I wanted to intentionally double down on South Korea. Also, it has a small cap inclusion that would give me genuine breadth. Now, so far, you'd probably notice that to get to true international exposure, you'd ideally use two of these ETFs in combination, so pairing one developed market ETF with one emerging market ETF. That gives you broad international coverage, established economies, and higher growth developing ones. A simple example, say you want international to make up 20% of your total portfolio. You might put 15% into XEF, that's the developed market fund, and 5% into XEC, the emerging market fund, or 10% and 10% if you're more comfortable with emerging market volatility. You could also do a Vanguard combo and put, for example, 5% in VIU and 5% in VEE, or TPE with XEC. These are just examples. There's no single right answer. In the end, it comes down to your risk tolerance and your view about how the world will develop. How much you want in international versus North America, how much you want in emerging markets versus developed, and how much concentration you'd like in individual countries. For example, South Korea or China or India. Now, personally, I'm not overthinking it too much. You are not locked in forever once you choose one of these. If you start with one and later change your mind as your knowledge grows, you can always sell and reallocate. But for that to happen smoothly and at a low cost, make sure that you invest on an investment platform that does not charge you any trading fees for buying and selling ETFs. There are many good options in Canada, and you can buy all the ETFs we talked about on almost any reputable financial trading platform. But here is my favorite investment platform that I've been using for over 5 years. Well, it's simple. It's Canadian, beginner friendly, and has no trading fees for buying and selling ETFs. You can hold your TFSA, RSP, and non-registered accounts all in one place and buy any of these ETFs we talked about just now in a few taps. It's also super easy to use even for beginners. Currently, they're also running this giveaway, Monthly Millionaire, where clients can earn entries for a chance to win a $1 million grand prize every single month with every dollar saved in an eligible account. And you can even double your chances by depositing your paycheck automatically. And you can even get a $25 bonus straight into your account if you use my affiliate link or code in the descriptions down below when you sign up. Full disclosure, guys, I am not sponsored by Wealthsimple, but I may earn a small commission if you sign up at no extra cost to you. Now, putting it all in context. So guys, remember that the ETFs we talked about today only cover the international portion of a portfolio. If you're already invested in Canada and the USA, like I am, then you have the option of adding one or two international ETFs for more diversification. Also, they only cover equities, so in case you want bonds to lower your risk, these ETFs will not cover that. And just in case you're new or newer to investing or are in the process of rebuilding your portfolio, consider all-in-one ETFs. They cover international markets, and you even have the choice between highly aggressive all-in-one ETFs with 100% equities or those with lower risk, for example, with only 40% equities and 60% bonds. If you want to learn more about all-in-one ETFs, then join me in this video now.